In this moment, what it felt like was the invisible hand suddenly became very, very visible, and it's attached to someone who is very, very much antagonistic to your interest. So I want to ask you, how much did the limitation of, the platforms like Robinhood, where people were doing a lot of this trading, on buying new shares of these stocks, impact the eventual fall of the price? And how much was it this other piece which you talk about, which is the fact that the people involved weren't a natural constituency, weren't a natural kind of like class group that could hold together for the long term?
Yeah, I mean, it's hard to say at this point, right? Because this big fall in the price, which has happened fairly recently, is still happening.
Hmm.
So it's difficult to say what exactly broke the people that were holding these shares, but I'm sure that part of it was the decision by some of these platforms not to allow people to buy anymore. I mean, it was once that momentum stopped,
Hmm.
once the price stopped ticking up and up and up and up, people then suddenly started to think, right, okay, well, I have to make a decision now. Do I stay in and basically commit the amount of money I've committed to this, knowing that it is very risky and uncertain, but doing so out of political commitment? And again,
Mhm.
that comes down to that question about the fact that these people are not a class. They are
Hmm.
not, a people necessarily with a similar set of material interests that would kind of bind them together. They're not even a class kind of in themselves, let alone a class for themselves. Um, and yeah, at that point, the fact that these platforms have gotten in the way, and also that there was this a sense that there was this combined assault from the establishment. I think then led people to basically think, right, well, a lot of people to think, right, well, it's not worth it. And of course, some people did stay in, did commit to this, and they lost a lot of money. Like people have
Yeah.
lost hundreds of thousands
Yeah.
of pounds.
Yeah. There's a lot of unsophisticated investors who got swept in on this. I think there is a good faith criticism of Wall Street bets, which is, some of these day traders have a lot of money. They're very sophisticated and they have a sense of when to get out. And they have, they can make material gains by not, just screwing over the hedge funds, but by, screwing over, some Redditor who just, was
Mm.
unemployed, just got a stimulus check.
So I've read like recently some articles suggesting that some of the big accounts on Wall Street Bets have either been sponsored by or bought by financial institutions or
Wow.
powerful investors and are being used. Like I don't know if that's true. This is just something that I've seen being
I,
speculated
I
about.
would not be surprised.
Yeah, I mean, obviously, like lots of big financial institutions are now going to see this as a mechanism, as part of their strategy, right? You're probably going to see a lot of them getting onto Reddit in one way or another.
Well, these institutes, I mean, part of the narrative that I've seen, and this is the positive, framing of this, is that, these old stodgy hedge funds, they don't know what Reddit's about. We're internet, base, I'm trying to think of a polite term here. We're internet dipshits, and we're utterly powerless. But we can do one thing: if we get together, we can screw these guys over because they don't read Reddit, they don't read 4chan or whatever. But that is just not the case. And the hedge funds and these incredibly sophisticated social media, what you call it,
Like analysis, yeah.
analysis. Yes, exactly.
Yeah. Like this reminds me of I was listening to a show. You guys know Trash Futures, our friends in the UK,
Mm.
talking about how there are increasingly so a lot of investors are using algorithms to analyze the speech patterns of like CEOs and executives and board members when they're talking about the performance of their companies, and combining that with like social media analysis to determine which stocks are over and underpriced. Like these people
Mm.
know what they're doing when it comes to technology. Like investing in financial markets, just investing in capitalism more generally is like a technological arms race. So yeah, I think this whole narrative of like the Reddit chads versus the kind of Wall Street nerds is probably a bit of wishful thinking on these people's part, unfortunately.
So is the goal then, when financial institutions get involved in buyout, get involved in these Reddit channels, to also participate in this kind of market manipulation, if you want to call it that, going forward? Or is it that we're saying that they bought they got involved, they bought the stock off of these folks to sell it and drive the price back down to provide cover for those who shorted and the larger institutions that had a lot on the line?
So I think answering this question requires looking at some of the bigger trends that we've been seeing in financial markets recently, and maybe thinking a bit about how financial institutions are positioning themselves with regards to those trends as well as with regards to these ones. And I mean, the big thing at the moment is policy. Well, people who are in these spaces will call policy, which is basically talking about quantitative easing, because the way in which central banks have just created new money and pumped it into asset purchases, which has just driven stock prices just through the roof. This is, until the kind of the collapse we saw earlier this year, Wall Street had seen the longest bull run in history. The S&P 500 had seen the longest bull run in history. Things like the market capitalization to GDP ratio, which measures the kind of total market capitalization of stocks in various different indices against GDP, was through the roof. It was like higher than the financial crisis, higher than the tech bubble. This was just, really creating a very both volatile environment, especially with the wider economic context, but also one in which it seemed like everything was overvalued. And in the context that everything's overvalued, everyone is desperately seeking out the next big thing. That's what happens when there's a bubble. But when we're in this situation now where it seems like we're in a kind of, mega bubble, where you have bubbles in lots of different areas like, Bitcoin and lots of tech stocks and things, it creates this kind of volatility. And like I said, that's what makes it into this kind of arms race between these financial institutions, because you have to you have to be able to generate a certain return for your investors. And if you fail to do that, then you're out. It's the kind of logic of competition as it manifests itself in financial markets. So these people are going to do whatever they need to do to generate the returns that they want to make for their clients and to get their commissions and to get their bonuses. And if that means like logging on to Reddit and having personal accounts where on their lunch breaks they sit around and try and coordinate, a different sort of thing to like boost the prices of stocks that they hold, then I'm sure that they will do that. They'll probably come up with more sophisticated ways of doing it. But yeah, they're going to do whatever they need to do to make money.
Are we in a situation where this asset bubble, this has to be maintained by, that is the primary objective of, every government and every central bank, with, either by low interest rates or just pumping money into the economy? Because you remember when the stock market crashed back in March as the pandemic was beginning, and that felt like a real correction. And immediately Congress turned on the fire hose, immediately passed $2 trillion package that included some money for the little guys and then trillions of dollars in loans to big corporations.
Yeah, I mean, I think if we were ever going to see a recalibration of central bank policy, it would have been during that dip, because there was a sense that this wasn't the fault of central banks. Obviously, if there had been a halt to quantitative easing at any point before that, it probably would have had like quite severe ramifications for financial markets, and central banks would be blamed for causing a crash, which would be very problematic politically. The fact that this then happened potentially gave them an out, if not to unwind their balance sheets, then at least to kind of, step back from the QE fire hose, like turn it down a little bit. But instead they turned it all the way up. And I think there are two reasons for this. The first one, and this is what, central bankers will say themselves, because they will, say that they are non-political entities that have no relationship with other political or economic institutions, that basically this is required for financial stability. And in part it is right. And this is an interesting part of the argument about like the structural power of finance in our economy. One of the ways in which this is an important argument, because in a sense, it's true that had central banks not done what they did, the recession probably would have been worse. I mean, it would have been worse because wealthy people wouldn't have been as wealthy, because they will have potentially lost a lot of money either through decline in house prices, the value of their pension pots, whatever. But like that would have had an impact on the recovery. But it also, would have cut to the core of what a lot of people see as the central problem central banks are facing at the moment, which is how the hell are you supposed to, stop QE, let alone unwind QE, without creating havoc in financial markets, and without making a lot of people very, very angry at you. But then there's the political reason for this. And, as much as central banks are nominally independent, they are obviously very clearly influenced by wider political considerations. And this is what I wrote about in the article, really. It's like there's a reason that various different like neoliberal politicians over the last 40 years have been desperate to encourage ordinary people to invest in stock
Yeah.
markets. It's because it provides the political foundations for, it's part of a wider hegemonic strategy that seeks to convince everyone that everyone can be middle class. And it also links the interests of that middle class to the very, very wealthy at the top of society and says, look, if those politicians are undertaking policies that are inflating asset prices, that are increasing wealth inequality, the vast majority of that wealth is going to go up to the very, very top, to the top 1%, 0.001%. That if the middle classes is getting a fraction of that, is becoming slightly better off, then that provides some sort of foundation for that model continuing.
I want to, if I can, just take a step back and explain quantitative easing, because I
Yes.
suspect that there are some people listening who might have gotten a little warbly in the knees during that part of the conversation.
Sorry, yeah.
Myself included. So when we're talking about quantitative easing, we're talking about injecting large amounts of money into the financial sector to stabilize the economy.
Yeah, let's start with like who's doing it. So this is a central bank policy. Nominally, in most kind of developed economies, central banks are independent from the government. So you have the Treasury that does kind of direct government spending and manages fiscal policy, so taxes and spending. And then you'll generally have an independent central bank like the Fed or the Bank of England, which basically controls monetary policy. So this is everything to do with money. They set interest rates, which is what most people will be familiar with when we're talking about central banks. But we got to a problem in the wake of the financial crisis, which was that interest rates were very, very low, and yet that wasn't stimulating demand. Now, the reason that interest rates are supposed to stimulate demand is because it makes borrowing cheaper and it makes saving less attractive. So people are supposed to dissave, take out savings from their savings pots and spend them, and they're supposed to borrow more money and spend that. The problem that we had after the financial crisis was that we had a big debt overhang. It was this, big debt-driven crisis. We saw an explosion in household debt across the economy, and also in corporate debt as well, which has skyrocketed since then. But particularly household debt, and households were trying to, what economists call, repair their balance sheets, which basically meant pay off their debts and accrue some savings. So in that context, trying to incentivize people to borrow with cheap borrowing wasn't really going to work. The only people it was going to work for was largely people who already had healthy balance sheets, who already had assets. So very, very low interest rates after the financial crisis largely helped the wealthier, particularly people who already owned homes. And this has been a big part in the UK of the growing intergenerational divide in home ownership, is that a lot of people who were able to purchase homes before the crisis were then able to purchase second homes during the very low interest rate period after the financial crisis and become landlords. So low interest rates weren't stimulating demand. So what central banks did is borrow a policy that was developed by the Bank of Japan in the wake of its housing bubble, which happened in the 1990s, and create new money, which central banks are able to do. Like a lot of money creation happens via private banks through loans, but central banks do create new money themselves. And they basically use this new money to purchase different kinds of financial assets. Mostly that was government bonds. Now, central banks had already been involved in the bond markets because it's part of the set of tools that they use to influence interest rates. But the shift was towards buying long-term government bonds. So central banks bought shitloads of government bonds. In the UK, the Bank of England ending up holding a huge chunk of outstanding government debt. And they did this in the secondary market. So they bought these bonds off other investors. Now, this was supposed to, there were a lot of different initial theories as to how this would work. There was one kind of bogus thing that was like, oh, this will increase lending because it will give banks more money. Now, that's bogus for a whole load of reasons that we won't go into. But effectively, the way it ended up working was that investors got given this money, they gave the government their bonds, they had this pot of money, they have to, maximize their returns, they have a fiduciary responsibility to their investors, they need to get the highest returns they possibly can. So they took their money and they were like, right, where can we invest it to generate the highest returns. That basically led to this flood of money that had been created by central banks going into stock markets, into housing markets. A lot of it went into the global south, which is a big part of the debt crisis we're seeing now, because that money flooded in and now it's flooded out because of this crisis. And as a result, we have the really huge imbalances that we see at the moment in financial markets. So things like, in the US, there has for a long time been this bubble in corporate debt because it's been so cheap for corporations to borrow, both from banks, but also from financial markets by issuing bonds. So there was this really big rush into high yield corporate bonds. Now, why would a corporation elect to issue bonds that have high interest rates, as in that cost them more because they can't get access to credit because they're not a good bet? So these were not really often financially stable companies, but because there was all this money floating around, investors were like, well, we're going to chuck our money into this anyway. Does this ring any bells? Pre-2007, It was obviously much less, significant, but it was still important. So we had the massive increase in corporate debt. We had rising house prices again, particularly in places like London, where housing is very integrated into financial markets. Massive boom in US equities, and a big lending spree in lots of other parts of the world. And that created a huge amount of instability. It was kind of really, it's almost like a house of cards. And the issue that we have today is that this is not something that's been done before, let alone on the scale it's being done on now. So no one really knows what's going on. And when no one really knows what's going on, that creates volatility, it creates uncertainty, and it creates crazy swings. Because if you don't have a foundation upon which you can accurately value a company or a stock or a bond, because there's so much money swishing around everywhere, then you're just going to follow patterns. You're not going to be able to do value investing. You're not going to be able to say this stock is worth this much because this company is this good. You're just going to follow what everyone else is doing. And that's what we're seeing at the moment.